right. Welcome, everybody. My name is Kyle Schuman. I'm the marketing director here at Von Lehman CPA Advisory Firm. Just like to welcome you today to our webinar, all things fair lending. So talking about recent developments, trends, and important issues that you should be aware of. So before we get started, just want to go through a couple of housekeeping items with you. First, if you have any questions, enter them into the chat feature. We'll make sure to address them throughout today's presentation. And then also, Carl Pry will be going through a bunch of slides as well as energy insurance. So we will make sure to send those slides after the presentation today, along with the speaker's information. So before we get started here, I'm excited to have Carl Pry here for, I believe, his third time now, speaking with Von Lehman and various partners. But before we get started, I wanted to turn it over to one of our partners that we thank today for doing this event with us, Energy Insurance. So I'll turn it over to you.
Thank you, Larry. Hello, everyone. My name is Joe Prakowski. Thank you for joining us today. I am with Energy Insurance, and we have a banking division, and that's why we're part of this Von Lehman presentation. And I'm just going to take a few short minutes to describe, if you're going to talk about fair lending, the new responsibilities of the bankers and making sure their I's and T's are all done correctly. Well, there's some insurance issues that are related to that and several products that address these lending issues. So on your screens, you should be able to see my little title, Bank Liability, Exposures and Risk. And I'm just going to go through a couple quick things here and see if we can take you through some of these coverages. Now, obviously, computer and cyber are turning into be huge issues. And one of the largest issues that most of the banks are not paying attention to is their credit cards and plastic cards. Most financial institution insurance companies have some coverage on their financial institution bond called debit bond coverage, but that does not cover bank cards. It does not cover credit cards. It does not cover worldwide international transactions. The deductibles on a banker's bond are very high. Deductibles on a separate plastic card or bank card protector program could be as low as $1,500 for one card loss, and we could cap that at $10,000, which is probably the deductible you have on your bond. Now we have all the skimming issues, the phishing issues, and now we have farming. Farming is all these other tech marauders who are stealing your web page, making a web page look like the bank and getting the customers, give them the information for transactions, and then they take all that money. So that's a huge exposure, and we think it's something that needs to pay attention to. So I assure you, 95% of you are not buying the proper plastic card coverage. We started with the comment about computer crime. Some computer crime coverage is on the bond. That's a good thing. The bad news is if you have a loss in computer crime in the bond, it's going to affect the loss ratio for the bond history, which means your premiums will go up when you start having computer crime losses. We are from the perspective that if you can buy separate coverages off the bond with broader coverage, then you may want to look at some computer crime through programs like Beasley. They have the verbiage, and they have risk management tools for the banker's IT department, protocols to place in there to protect you from all these fraudulent access, loss of use. Even if the customer doesn't have good PC controls, it'll protect the bank from loss. So that's an exposure which we know exists today. Now, another coverage that most banks are not buying properly is mortgage impairment, mortgage errors and omissions insurance. Most of the banks are tracking the insurance that the banks buy, the customers of the banks buy. They have to have their homeowners policies. They have to have their commercial insurance policies, and you track that. The problem is you usually track it with some folks or some department who are so busy doing loans, they really don't have time to track all these insurance policies. So when policies lapse, there's a gap there. And if you don't react to that gap, there's no coverage. And so there are mortgage impairment, mortgage errors and omissions insurance that not only provide you the proper protection, they can be written on a blanket policy, meaning you verify the insurance at the time of loan, and you can have full coverage from that point forward. Once you find out a customer is uninsured, then you've got 90 days, so you still have coverage. So coverage is in force for you to react on it until you take possession or have to foreclose. And at that point, we would write a master policy for any of these properties that the bank had to take over. This falls right along the line with the documentation you're doing for the flood program. And as you know, the flood program is changing drastically. It's going to be expensive. Some customers are going to beg not to be in the flood zone so they don't have to pay that premium. It's going to be a huge issue, especially starting in April 2022. Obviously, if something goes wrong with a mortgage loan and someone has a flood or a fire or a hailstorm, you don't provide the coverage, they're going to sue. So again, it's all related to the lending issues. Moving on to what you and I used to call the directors and officers liability policy, these companies are getting good. The forms are getting good. Most of the insurance companies are now calling this the management liability policy. It's much broader. It can include coverage for the bank. It can include coverage for all employees, including the lending employees. It can provide for fiduciary liability protection and the employment practices for the bank. The big one is this banker's professional liability, where the bank and anything they are deemed to be doing is deemed professional exposure or a license, insurance, for example, life insurance, for example. If there's an error, you could be sued for that. Well, the thing I've noticed is a lot of the insurance companies used to sell lender's liability separately. Now they're putting it under this banker's professional liability line. Again, the problem with that is you're diluting your limits and you're sharing your limits. So you need to take a look at these insurance policies to make sure that you're not just buying a $1 million D&O policy anymore that's sharing all these limits. You might want to look at a policy that sells 1 million of employment practices, 1 million of professional liability, 1 million for bank stock securities. That will broaden your coverage. If you can't get that, there are excess insurance companies who will write over your current D&O policy. So again, not all of you are buying the insurance policies for the bank, but this is an outline you can share with those who are responsible for buying the insurance. I think these are valid points, especially today. We started talking about cyber earlier. Well, you have data breach liability. Then you have regulatory defense, where if you did something wrong and the regulators are unhappy, you want to have a defense policy to protect you. The electronic funds transfer, the business interruption for computers is a huge, huge opening for a lawsuit. Now we're getting cyber extortion. The cyber extortion used to be on the bank bond under kidnap, ransom, and extortion. Now it needs to go on this computer policy. And then if you do have an issue, most of you have to buy to figure out how to defend yourselves. Well, there's public relations expenses built into these forms now. So again, it's new exposures for what's going on in today's world. So to wrap it up, my name's Joe Perkowski. I'm with Energy. That information will be shared with everyone, and I appreciate the opportunity. At this point, Larry, I think I'm supposed to turn this back over to you.
Thanks, Joe. And we really appreciate Energy partnering with us during this event, and glad you could be here and share some of that information. My name's Larry Brown. I lead the financial institutions practice here at Von Lehman. We do independent audits, financial statement audits, internal audits, compliance reviews, loan reviews, IT audits, pretty much full service provider. Our goal is to make audits a painless process and help the banks mitigate risk, and also be more efficient in their operations. So we are pleased today to have Carl Pry join us. Carl is the managing director of Treelion, has over 18 years experience working with bank compliance and especially fair lending. So thank you again, Carl, for joining us, and I'll turn it over to you.
Oh, you bet. Thanks, Larry. And geez, I'm going to have to update my bio there. I've actually got close to 30 years, and maybe I don't want to change my bio. It's making me feel older and older by the day. But what can you do? Let me get that going. All right, Larry, are you seeing that? Okay.
I can see it.
Very good. Okay. Well, let's talk a little fair lending. And if any of you have heard me speak before, you know I am very informal. So if you have any questions or comments or war stories that you'd like to tell, feel free to text them in, and Larry will not be shy about interrupting me and posing those as we get them. You see my email address down there at the bottom if something occurs to you later on that you feel like asking about, or maybe it's something that you don't feel like posing in front of the larger crowd. Not a problem at all to get a hold of me later. Larry will tell you that I can easily block you just like I block him. No, I'm kidding. More than happy to answer any questions that you may have later. And you may have some, because honestly, fair lending is an amazingly dynamic topic today. I don't think that's a surprise to any of us here, but I'm sure you're dialing in today to listen to what do we need to pay attention to, and what do we need to look forward to in the months and the years to come. We've got to do administration. They've been very vocal in their public issuances and public statements around consumer protection and fair lending. And that's all fine and good, but what does that mean to us? What do we need to do? What do we need to put into place? And if any of you are responsible for communicating with your executive management and your boards, perhaps, I'm sure they're asking questions. And if they're not, you need to let them know, hey, these are big things going on here, and there are certain things that we need to prepare for in this environment. So what I'm going to do here is really just cover the landscape. This is not going to be a fair lending 101 type of session here. There's going to be the baseline presumption that you know what I'm talking about when I say things like disparate impact and protected classes and all that type of stuff. No, we're really here today to talk about where we are as an industry and really as a regulatory environment of fair lending, and really the larger consumer protection environment here. When you get your handout later on, and I assume you'll get it in PDF form, but anything that's blue and underlined here on these pages is a website link. So if you would just click on the word published or the supervisory highlights, you're going to go right to that press release or right to that particular report. My goal here is to make it easy rather than trying to surf around and use Google to find all this stuff. All those are links, and just be sure that you're viewing this thing in a PDF reader like the free Adobe reader. Sometimes the web browsers, you know, the Chrome or Explorer, the links don't work, but I know a lot of banks will, as a default, make you open up PDFs in the website browser to do a virus scan, and certainly nothing wrong with that. But if you're wondering why the links don't work, that might be the case. And I'm holding my nose here because I'm fighting off a sneeze. I'm actually out here in Arizona, and it's a little bit after 8 for us out here, but I don't know, just the mornings out here drive me nuts, and I've got some allergies. I thought people moved out to Arizona to get away from allergies. I'm from Cleveland originally. I'm an Ohio guy, but seems like it's even worse down here sometimes. So there's definitely something in the air. So if I need to sneeze for a moment, I'll try to mute myself out as to not to blast you awake if you're starting to fade there. All right, so let's talk about where these things are right now with regard to fair lending. And the first thing let's talk about is the supervisory highlights report as published by the CFPB. And this is one they published back in June. So of course it was published by the current, meaning new leadership of the Bureau, but it really reflects the Bureau's activities in 2020. So it's an interesting viewpoint of what the Kathy Kraninger's CFPB did, even though we have new leadership here at the Bureau. But these are always fantastic resources. I always recommend to compliance people that whenever the Bureau publishes their supervisory highlights or their regulatory agendas, they publish a lot of reports. One thing that the Bureau does very well is they're very transparent. So they always tell us as an industry, this is important, this is something that you ought to learn from, and this is what we're finding. And especially these days when the examiners and the agencies are really regulating by enforcement. Now, they will deny this up and down, of course, publicly, but we all know that is, of course, what happens. It's always useful for us to learn from others' mistakes. And if you want to put it that way, I think that's pretty appropriate. So if you want to learn what these regulators are really looking to and what their goals are and what they're going to be examining in the future, their reports is really the best source of information, as well as the published enforcement actions. So we'll talk about some of those here as well. So we have their report that they issued this past summer, and the supervisory highlights covers the whole gamut of compliance. Now, I've certainly focused just on the fair lending aspects of that report here, but you'll see things around disputes and mortgage and complaints and other areas. But you see some of the issues around fair lending that were in this report. And they mentioned LAR inaccuracies on the HUD side. So the regulatory attitude is to get a little more strict than at least what I've seen in prior years around the accuracy of HUD data. Now, of course, that's always a goal that we have as banks, to make sure that you're reporting accurate HUD data. But in this environment where this information is very public, it's more available than it ever has been in the past, because it's now on the CFPB website, that you want to make sure your data is accurate. And the regulators have started to cite penalties for data inaccuracies on the HUD side. So they mentioned that certainly is noteworthy. And they talk about violations of Reg B by actions directed at prospective applicants, in other words, your prospects, that would discourage people in minority neighborhoods, in underserved MSAs, from even applying for credit. Now, this really refers to a subpart of Reg B around discouragement of applications. So I come into the bank and I talk to Katie, my loan officer, and she says something, well, if I were you, I wouldn't even borrow or applying. You know, we don't make loans to people like you. I mean, not that you would ever say anything like that, but my point is you want to be sure. So in your fair lending training and in the activities that you engage in, just make sure you reemphasize to frontline staff the importance of always encouraging everybody, even if you know darn well I'm never going to get a loan. And in the end, do you really know that with 100% accuracy? I mean, maybe there's some compensating factor, maybe there's a program you're unaware of that I may actually qualify for. So discouragement is yet again an important point. Never was unimportant, but certainly the fact that the Bureau emphasizes it means they are looking at it. And of course, redlining. We're going to spend some time here talking about redlining, because this has been a big deal, at least for the past 5 years. Now, redlining is not a new concept. And here's your trivia question of the day. Who invented and first publicized the concept of redlining back in the 1930s? And the answer was the federal government. The most ironic answer to that question. The federal government, in the throes of the Depression, recommended that banks be very careful when lending in certain geographic areas. Now, of course, their point was not to be discriminatory on any sort of racial or ethnic basis, but rather safety and soundness. And because the Depression caused so much widespread economic turmoil, there were certain areas that if you made a mortgage loan or a commercial loan, it was more than likely to go belly up, hurting the financial position of the bank. Now, of course, you combine that guidance, which of course banks took very seriously, and the population and demographics within the last 50, 60, 70 years has resulted in those areas that are primarily harmed by redlining turn out to be minority neighborhoods. Now, the term redlining didn't really come about until the 1960s, but it was really originally a concept that the federal government was pushing back in the 1930s. So I've got a quote here from the that report here around what redlining is all about and what the findings were. There are some examples of enforcement actions in that report. They have a complaint against Townstone Financial, and this is kind of the poster child for redlining. It's a pretty obvious case, and For those of you that are wondering, well, what's redlining all about and what will the examiners look to, that might be a good thing that you might check out. So I put a link to the complaint around them, and sorry to call out Townstone publicly, but it's public information. I'm not calling anybody out in secret here. Now, here's the other great resource that you want to get a hold of, and that is the CFPB's Fair Lending Reports. The Dodd-Frank Act requires the CFPB to report to Congress every year around its fair lending activities. So in April of this year, they issued their Fair Lending Report, again regarding their 2020 activities. But the spin they put on that and the forwarding comments, I think, are pretty important here. But if fair lending is in any way important to your job responsibilities, absolutely you want to click on those links and read those fair lending reports. And they're all out there even for prior years. And I'll make reference to some of the ones in prior years as well, because again, the CFPB is very upfront about stating their priorities and what they will look to. So we're going to talk about some of those priorities: redlining and small business lending and servicing, to name but three. Now, I mentioned the forwarding comments from, at the time, the acting director of the Bureau. Of course, we now have the fully installed and blessed director of the Bureau, Rohit Chopra. And he is, of course, settling into his new digs in DC and going to start doing a lot of very interesting things. Let's just say that he's certainly going to hit the ground running here. But we'll take a look at some of these comments from, at the time, the acting director, Luigio. Top priorities for the agency: bold and swift action to address issues of pervasive racial injustice as well as the pandemic. Those are really the two themes that you see from the CFPB above all others. Fair lending in terms of racial injustice and inequality, and you can mix a little UDAP in there as well. So fair lending and UDAP risk are sky high right now, as well as the impacts of the pandemic. Now, those are not two distinct concepts either. The belief in the Bureau is that the pandemic and the resulting economic consequences have only made the existing racial injustice issues worse. So if you need no other information to convince your board or executive management that fair lending is a big deal, I would put some of these quotes right in front of them here. And the fact that they mention the words 400 years of chattel slavery and Jim Crow, that is pretty striking from a federal agency leadership. You rarely see terms like that. And they don't say that banks are involved in Jim Crow or anything like that, but on some level, they don't have to. I mean, they're certainly very clearly signaling what their goals for the next few years are going to be. And as we know, the term of the new director is 5 years. So this may extend out even beyond 2024, depending on what happens then, right? So there's a lot to pay attention to in this area. And then in that report, they reemphasize the priorities that they had stated in the past around mortgages and small business and student loan originations. Got some other particulars here in that report here on page 4. They mentioned some of their activities that they've been engaged in over the years. They mentioned their fair lending help desk. Now, before you get excited that, hey, there's a dedicated phone line or email address and I can send questions to the Bureau, this is not what they're talking about. I was kind of interested to think that's what they were talking about, but really their help desk is at various conferences. They set up a card table and talk about fair lending issues. So nothing more than that here. But they do mention the changes in HMDA, which we are very familiar with, I'm trusting, so no reason to really go deeply into that. But they do mention some HMDA articles that they had published. And I've got the link to the 2019 mortgage market activity and trends. Note that the link that's in the report, if you're reading the report, that's inaccurate. So I've got the correct link in this presentation here. So if you're trying to find it through the report, it doesn't get here, use this link here. But these are all important because of the statistical analysis and results of HMDA data. This used to be published by the Federal Reserve. There was a gentleman there by the name of Glenn Canner. He now works for the Bureau, and there's a lot of statistical information available there, and also information now on 2020 HMDA. And we could get into a very deep discussion on the statistical necessities of understanding where your bank's data sits in relation to the more macro level data, but you can get a lot of good insight from those two reports there as well. And then they just made public the information around the HUD data browser and the availability of the information on the Bureau's website. And they have a presentation and a recording of a webinar that they have presented on that tool. So if you're wondering what's available there and what you can get a hold of from other institutions, those may be some good links that you might want to click on and discover more. But then there's information around the Bureau's efforts to expand access to credit. And I really should have, excuse me, underlined or italicized those words, access to credit, because in the end, that's what it's all about. That's what fair lending is all about when it comes to the CFPB and really all the regulators. That banks, that fintechs, that mortgage lenders, they do not properly make access to credit fairly and equally available to everybody. Now that covers the entire range of the lending process, advertising and product selection and redlining, you name it. So really when you see access to credit, that is what the Bureau is concerned about. And if you are unfairly denying access to credit based on the prohibited class characteristic, that's going to be a fair lending problem. So that, I don't want to say that's their code word, but you see that quite frequently here. It's not as inflammatory, I guess, as saying fair lending and illegal discrimination, but access to credit is pretty much the same thing. But they talk about underbanked and underserved and these distressed areas and populations. And unfortunately, a lot of these dovetail with either LMI areas, low and moderate income areas for CRA, which of course then correlate with lower income, which sometimes correlate with higher racial and ethnic characteristics as well. So all these terms that they float and discuss in these articles, I'm not saying they're purposely coding their discussions here and using other terminology, but you have to understand ultimately what they're talking about is banks not treating people fairly and unfairly denying either access to credit or loans themselves. So let's talk about a little more information around the new administration, which clearly has new priorities and really different priorities than what we've seen from the prior administration. Now we have the new director who was sworn in just last week, and a couple of comments that he said. I've got the link if you want to take a listen to his comments in the swearing in ceremony. And he very clearly said, we're going to build on the work that acting director Eugio had done to address racial inequality. There's that term again. And the pandemic put into clearer focus systemic structural barriers that we must overcome to build a more inclusive economy. So what that means precisely, we don't really know yet. I don't think we'll have to wait long to certainly see some of their priorities. And by the way, somebody's got their, somebody's typing away. If you don't mind muting your microphone, that would be fantastic. But you know, those phrases that we see there again, racial inequality and systemic barriers and more inclusion, fair lending is of course front and center in that effort as well. I would even refer you to the comments that the now director of the Bureau made back
in the meeting. This meeting is being recorded.
Okay, before the Senate, when he was speaking about his original nomination before the Congress to be installed here. And there's a video of his comments there, and emphasized combating lending discrimination and said fair lending will be a top priority. And the fair lending and equal opportunity, I'll spit it out, equal opportunity, need to slow myself down here, office established by Congress should play a critical role in making sure the law is being followed. That means that enforcement will absolutely be a top priority of the new CFPB. Now, even if you're not a bank that's supervised by the Bureau, you're saying, well, I'm not 10 billion, I've got to worry about the FDIC or just the OCC. Do they take the same viewpoint? The answer is clearly yes. Now, they won't state it publicly, but of course the CFPB is the top dog when it comes to regulators here, especially when it comes to fair lending. But they absolutely take their clues and marching orders from them as far as the regulatory environment. And I've even got a couple statements from the acting director back in January when he took control over the Bureau as far as what he's going to do. And of course, it's among the same theme, along the same lines here, top priority, fair lending, all that type of thing. So plenty of ammunition here, plenty of information that very clearly states what they've got going on. I've got some blog posts from the acting director back in the middle of the year. And these were really messages to the public, to the industry, to us, even though they were styled in memos that the acting director was issuing to staff that he then published on the CFPB's blog. So more along the same lines here. So don't mean to use a sledgehammer to make that point, but obviously it's one worth making. One advantage I can tell you of working with a firm like Treline, we are DC based, and we have a lot of discussions and connections with people in the legislature, in Congress, and at these agencies. So we can ask pretty honest questions about, hey, what are you guys doing, or what's coming down the road, or are these, are these statements here just publicity, or do they really have teeth? And without fail, the message is, oh yeah, they absolutely mean business. We also work with a lot of law firms, and they are communicating very clearly to our clients and the third parties that they work with, such as us, that there are a lot of enforcement actions in the pipeline here. So the environment absolutely has changed. It's not just a rumor. Now, if you're wondering what may happen in Congress, in other words, would Congress do something to tighten up the rules and make some changes? The answer is maybe. Now, of course, Congress has enough going on, and I mean, all you need to do is just dial into the news or pick up a newspaper and figure out what's going on there. So it's not like fair lending is front and center to them. But the fact that some of these issues are discussed in subcommittees is noteworthy, simply because this is where legislation begins. This is where it has the beginning of its roots here. Now, I want to make very clear before we go any further, this is by no means anything that is law. It's not even close to being law. It's not anything that's even gotten out of a House of Representatives subcommittee. So don't want to panic anybody to think, oh my God, things are going to change here and the laws are going to get a lot more strict. No, but it's again noteworthy to understand what they're talking about and some of the ideas that are floating around in the present Congress. And earlier this year, within the House Financial Services Subcommittee, they had a hearing and they discussed a piece of legislation that actually had been drafted and floated. And that hearing was titled "How Invidious Discrimination Hurt or Works and Hurts an Examination of Lending Discrimination and Its Long-Term Impact." So that was absolutely on point. And I've got the link if you want to. I think that's a recording, or maybe it's notes. I don't know if you want to find out more about that here. And then I got a link to the memo that was issued around exploring all available tools and potential legislative solutions to detect hidden discrimination. So they talked about a number of topics: redlining and the wealth gap and match pair testing, which rings a bell to those of us who've been doing fair lending for years. And I've been doing fair lending for at least 25 out of my 30 years in banking. I was a fair lending officer for about 10 years at KeyBank back in the day before I went to Treline as well. So match pair testing and statistical analysis and regression testing, all that stuff is certainly in my background here. But here's what they floated here was House Resolution 166, which they call the Fair Lending for All Act. And if this were to become law, what would have it done? Well, the Bureau would have established an Office of Fair Lending Testing. And they would have actually tested and dove into some statistical analysis of lending patterns. So certainly up the game as far as regression goes. And they would have extended protected class bases to include sexual orientation, gender identity. That's already been done. We'll get to that in here in a moment. But also an applicant's location based on zip code or census tract, which would have memorialized redlining, which you would have essentially assigned me a geographic, so geocoded me. And that would have been a much more critical factor for the Bureau to test. So redlining testing would have gone up a notch or three. Criminal penalties would be introduced under ECOA and Reg B for knowing and willful violations. So certainly the stakes in the game would increase there. The Bureau would be required to review applications for compliance. Now, what that means and how they would do that would certainly be an open question. But certainly the examiners coming in and examining applications, how would that work? I mean, that's kind of a scary thought. And then HMDA would be amended even more so than what we had in 2018. So a lot of discussions. Again, this is nothing that's even close to becoming reality, but again, it's instructive to understand what various people in Congress are thinking about. One other issue that I'll bring up here as far as what those on the federal government are thinking about, there's a GAO report, Government Accountability Office, issued a report in the middle of this year around how the CFPB handles enforcement of fair lending issues. Now, the backstory of this was within the prior administration, the CFPB underwent a reorg, and the Office of Fair Lending was removed from the enforcement arm of the Bureau and put under the Office of the Director. And that sounds like maybe a non-issue, and it maybe sound like, well, kind of a lateral move, but the Office of the Director is really more around educational efforts rather than enforcement. Now, that certainly alarmed a lot of community groups and a lot of activists out there that really signaled that the Bureau was going to take much more of a hands-off approach to fair lending enforcement. By the way, that didn't happen. We still saw an awful lot of enforcement actions, and kind of a little known fact that enforcement actions under the Trump administration stayed level and even increased a bit over what we saw from the Obama years. So the enforcement under the various activities didn't really decrease. And there may be a number of reasons for that. I don't need to really go into that right now. But the GAO was critical of that move. And I've got some information on that on the next couple of pages here. And there were some recommendations about what the CFPB could and should do here. Bottom line, this is at this point a moot point. And I say that because when the new administration took over and the new leadership of the Bureau, they returned the Office of Fair Lending to the enforcement arm. So there's not that criticism there anymore. But again, if you're looking for information from a government agency around how fair lending issues are enforced, this is a good read. And the more information you can get around the federal government's attitude and what their beliefs are, the more educated you will be to instruct your own institution in what fair lending is really all about and how important it is. Now, looking at page 10 here to understand also that fair lending and really advancing fair lending concepts is not the sole purview of the new administration. Last July, so over a year ago now, and of course, this is under the Kraninger CFPB from the Trump administration, the Bureau issued an RFI, and that is a request for information where the Bureau seeks input on ways to create a regulatory environment to expand access to credit and ensure that people aren't being treated unfairly. Now, when these RFIs are issued, they're not proposals, certainly they're not final regulations, but they are the first shot across the bow, if you will, towards changes in the law or regulation. And it's how the Bureau will treat and deal with certain issues. And frankly, they're looking to modernize some of these fair lending interpretations and rules. Now, of course, this is the CFPB, so they're limited in as how far they can go. It would take congressional action to really expand what ECOA would mean, but how it would be interpreted, how it may be enforced, and what the Bureau can do to really promote access to credit and prevent illegal practices. So whether you're talking about the old administration, the new administration, in the end, you see a very clear theme. And don't think for a moment it's just the Biden group that's really all over this. No, this has been a trend that's been building for some time, and the pandemic only made it worse and in some cases more obvious. So of course we have to certainly pay very close attention to that. Now, RFIs are always interesting to read simply because of the questions in this case, Bureau asks. So this gives you a lot of good insight into some of the areas that the CFPB is thinking about when it comes to fair lending. And I'll bet most people didn't read that RFI because they say, well, wake me up when it's a proposal. So until I need to actually do something, I'm not really going to pay attention. But if you want to pay attention to what may be coming down the road in the next 3 or 4 years, this is a good place to look. So there's a lot of great information out there. Again, the feds are pretty transparent with all this stuff. You don't have to look too far to find what they're thinking about here. So whether it's disparate impact analysis or sexual orientation, gender identity, adverse actions, special purpose credit, don't need to read these to you. And of course, if you're versed in fair lending, all of these should make sense to you here. But it gives you insight into some of the areas that they're thinking about. So give that a read and understand what they may be asking about as well. But let's get into more reality here. And what has the federal government done? And what must you do about it, if anything, here? Well, let's go back a few years and talk about the results of a Supreme Court decision back in 2020. I've linked you to it there in the middle of the page, and that was the postdoc case. This had nothing to do with lending. This is not a fair lending or a banking thing at all, but it's around civil rights. And this had to do with more employment and similar issues here. But the issue was still around discrimination on the basis of sex. Now, this was around the Fair Housing Act, FHA, which, as we know, applies to all housing-related situations, whereas ECOA applies to all lending situations. But that's why the FHA was at issue here. But the US Supreme Court did opine in their majority decision that sex discrimination does encompass both sexual orientation and gender identity. And frankly, this was new from the federal government perspective, but not new to the states. Many states had already had state laws and resolutions and whatever the case may be, prohibiting discrimination on the basis of sexual orientation and gender identity. So it's not a new concept. And certainly we've seen and read enough about these issues just in the press and many other contexts over the past couple of years. But to see the US Supreme Court interpret that phrase in that manner was pretty important. Now, after this case, and I think I've got it here. Yeah, well, these 3 pages kind of express what happened on the federal government's side. You look at page 13 there. Remember when President Biden took over, and the first couple of weeks he issued just a flurry of executive orders. Well, one of them was entitled Executive Order on Preventing and Combating Discrimination on the Basis of Gender Identity, Sexual Orientation. Well, in that executive order, he directed all the leadership of any federal government agency that had under their purview any laws or regulations around discrimination on the basis of sex, which in our case includes both HUD for the FHA and the CFPB for ECOA, to issue either bulletins or guidance or revisions to their regulations interpreting discrimination on the basis of sex to include both gender identity and sexual orientation. So that's what we saw out of HUD in February. And to go back a page, that's what we saw in March out of the CFPB. So got the links to all those, you give them a read, but now clearly discrimination on the basis of sex legally on the federal level means both of those as well. Now, the Bureau did comment that they will issue some additional guidance in the future as far as what this means. Now, you're thinking, well, what do you mean? What does it mean? We understand what it means. Well, think about HMDA. And you're collecting and submitting data to the CFPB every year around your mortgage loan applications. And one of those many data points is gender. Well, if gender is now sexual orientation and gender identity, is that data point going to be expanded into 2? And how do we actually do this? Do we need to change our application forms? Is Fannie and Freddie going to come out with a new 1003? They just came out with a new one last March. Are they going to redo it again? You know, what does this mean to us going forward? And the answer is, we don't know. The door is open for some possible changes. We're getting a fairly clear indicator of what they're going to do with regards to 1071. I'm going to address this here a little bit later on as well. And 1071, of course, is a Dodd-Frank provision that requires the CFPB to draft a regulation to collect and report data on small business applications. And one of those data points is sex. So how are they going to account for that? And we'll have some clues here that we'll discuss a little bit later on. But in the short term, nothing's changed. Don't need to worry about it. And but it's pretty interesting. When this all came out, I do a lot of writing as well, and I wrote an article for the ABA's Bank Compliance magazine on this issue and fair lending. And by the way, if you don't subscribe to that or get it, but you want a copy of that article, just drop me an email. I'll be glad to send you a copy of it. Just don't tell the ABA. But I'll tell you, it was really interesting doing research into this whole issue. And I'll be the first to tell you, I'm no sociologist or psychologist, anything like that. But researching what gender identity means. There are schools of thought that there are as many as 81 genders, believe it or not. Now, don't ask me to explain this. They're essentially different factors that if you combine them together, you get 81 different variations. And some people say there are 50 some say there are 60. And how are you supposed to manage that? How would you collect that on a loan application? I don't think it's really practical here. And again, right now, you don't have to do anything about it, of course. And in the end, I mean, we don't care, right? I mean, we shouldn't care. And honestly, we don't care, which of the 81 you would pick or anything else. It shouldn't have any impact on our lending decisions or terms and conditions. So we'll just wait for the feds to tell us what we should do, and then we'll react accordingly. The one recommendation I do have, however, around this is you might want to think very seriously about amending your bank's fair lending policy. Now, many of you may have already done so, and this may be completely old news to you, but every bank has a fair lending policy, and you've got, we won't discriminate on any of the following bases, and you've got, race and ethnicity and gender and income and all that, veteran status, whatever. You might want to include both gender identity and sexual orientation within that policy. If nothing else, that demonstrates to your regulator that you do take it seriously and you do keep an eye on current events. So your change management procedures are up to date, and this is a big enough deal that you would put it on there. And in the end, you don't discriminate on those bases anyway, so why not put that in your policy? Now, is that required? Is that something that you have to do? Can I show you chapter and verse of a rule or guidance that dictates that you do it? Nope, not at all. It's just my recommendation. And anytime you can demonstrate to your regulators that you take these things seriously and you're paying attention, it's always brownie points for you. So give that a thought. Give that a thought. Okay. So next topic here is the disparate impact rule. And of course, we got to have a nice long discussion on disparate impact. This is the theory that is all about the application of what we call a facially neutral policy or practice. You apply it uniformly, but the impact or the effect of applying that policy is to have a disproportionately negative impact on members of a protected class. And in the end, that's pretty much what redlining is all about. You make a geographic decision, but it impacts people that live in those areas, obviously. And if they happen to be predominantly minority, then you're going to have a problem. Now, this is, in my opinion, I don't want to say much, is it much ado or is it much to do about nothing? I think it's much ado, right? I'm not up on my classical literature, so much ado about nothing. But this is important more from the legal standpoint than from the compliance one. And we need to understand what happened just to understand the characteristics of the enforcement environment rather than anything that we need to do day to day. But this also was a result of a Supreme Court. Let's see here. Yeah, there we go. So we'll move on to page 16 there and look where it talks about the 2013 final rule. There was a ruling from the U.S. Supreme Court in what we call the inclusive communities case. And of course, this is what, 5-6 years old now. But very short story, the Reader's Digest version was the U.S. Supreme Court heard an argument as to whether the disparate impact theory was a recognizable, or what the court called cognizable, complaint in a fair lending or some sort of disparity related lawsuit. And we fair lending people were kind of waiting with bated breath as to what the Supreme Court would say, because nowhere in the legislative history of ECOA or FHA does it mention disparate impact. Thus, it might not be a recognized legal theory, because it involves some gymnastics as far as applying some of the standards. Well, long story short, the Supreme Court ruled that yes, indeed, it was a recognizable legal theory, although with some conditions. So the community groups and the activists breathed a sigh of relief, but the Supreme Court did say to successfully prosecute a disparate impact case, it would take a little more work than what we previously understood it to mean. And I've got information on those pages here around that, but but in the end, I wouldn't go to great lengths to understand what's going on, and the reason will be clear here in a second. But HUD then changed their disparate impact rule under the FHA, and that's what you see linked there, that final rule from HUD, to reflect the Supreme Court's decision. Well, so a lot of people were quite upset about that because that raised the bar to successfully prosecute disparate impact. Well, then President Biden took over, and one of the memorandums he issued very early on in late January was a directive to HUD to examine the effects of that rule that the HUD or that HUD originally put in place in September, one of the waning months of the prior administration. And in turn, what we saw is at the bottom of page 16 here, the OMB announced a pending proposal to reinstate the previous disparate impact rule. So if nothing else, that tells us as a lending community, the banks, the lenders out there, that the regulators and the administration intends to prosecute disparate impact on that previous more lenient standard rather than the more strict standard. Now, and here's what the proposal was to do that back in June. So a lot of information on that, and the HUD is proposing to recodify its previously promulgated rule. Now, dispense for a moment the whole discussion on, well, hey, didn't the Supreme Court change that? And shouldn't HUD reflect what the law is interpreted to be? Well, that's a constitutional issue. And, there's a lot of things going on at the federal government level that, there's challenges going back and forth. But what does it mean to us? Well, from a banking perspective, disparate impact is pretty much what it always is. It's a recognized theory. Examiners look at it very closely. But if the DOJ decides to prosecute your institution for a disparate impact fair lending issue, they're going to operate under the more relaxed and lenient prosecutorial standard for disparate impact. That's really all it means here. But again, it's more another nail in the attitude of the federal regulatory and enforcement apparatus. Now, more recently, the FHFA, which is the Federal Housing Finance Authority, this is Fannie Mae and Freddie Mac's regulator. They published a policy statement on fair lending, and it re-emphasized their comprehensive commitment to fair lending and also partnership with some of the other agencies around fair lending. So if your bank sells loans to Fannie or Freddie, you can count on a little bit more fair lending enforcement and scrutiny from Fannie and Freddie, and also some reporting responsibilities of Fannie and Freddie as well. So if you thought fair lending was just a purview of the CFPB and OCC and FDIC, Federal Reserve, nope. Fannie and Freddie are going to have their looking glasses out and looking at some fair lending issues as well. Here's the partnership from the FHFA, their policy statement on fair lending, and they and HUD entered into an MOU, a memorandum of understanding regarding fair housing and fair lending coordination that will, operate through December of 2025. So it'll be interesting to see what types of efforts come from that and what type of scrutiny and what will happen. So again, if you're a Fannie or Freddie shop, this is something that is certainly applicable in the fair lending environment. All right, so let's leave the feds for a moment here, and we're about halfway home, so we're okay. I'm looking at my clock, which is up there, which is when you see me glancing over there. I actually have 4 clocks on the wall. It looks like one of those air traffic control things. I'm gonna make sure I understand what time zone I'm in. You know that we here in Arizona don't change our clocks? It drives me crazy. So half the year I'm 3 hours behind you guys, half the year I'm 2 hours. Anyway, let's talk about some more I don't want to say up to date, but some relevant issues that I believe are very important to us as an industry. And let's talk about technology and the influence of fintechs, the importance of AI, artificial intelligence, algorithms, big data, all these terms that are floating around. It's very clear that we as an industry, whether you're a bank or a mortgage company or a fintech or whoever, that we are hurtling rapidly towards a completely automated environment. And the pandemic, if nothing else, really accelerated that trend. I mean, here we are talking about Zoom, and Zoom seems to dominate everything, and still very few people are back in the office. And the lending process can be entirely automated now. We could talk about aspects of what is known as RON, R-O-N, remote online notarization. There can be the situation where you can process a mortgage loan without ever seeing that applicant at all. The documents can be notarized remotely. And I sold some property a couple months ago and participated in one of these Ron sessions, and it was great, frankly. Didn't have to get in the car and go to the title company and get anything notarized and, you know, put your hazmat suit on just to walk into somebody's office here. Is basically notarization over Zoom. And, you know, you picked up your ID and you showed it to the screen, and, you know, they took a picture of it. The whole thing was recorded, and you docu-signed everything right there, and done deal. And you combine that with e-sign and UETA and all the allowances for doing things electronically, great. And it's a lot cheaper, it's more efficient, it's quicker from the bank's perspective. So why would you not want to do that? And that's the world that we're facing. Well, there are a lot of concerns and a lot of risks around that. And there have been some publications from the Federal Trade Commission, FTC, as well as the banking regulators just this summer around the risks of these electronic and digital environments. I don't think I have them in this presentation, but if you're curious to get a hold of them, just drop me an email and I'll be happy to send you the links here. But they talk about the risks of the digital environment. Now we're going to talk about the fair lending specific risk here in just a moment, but it's very clear that technology is, as usual, far outstripping the pace of law and regulation. But how do we deal with a digital environment with a regulatory environment that was really drafted and enforced for paper? That's the challenge that the regulators face. And honestly, what we face as an industry when we're trying to figure out how to comply. So we'll talk about digital redlining here in just a little bit. But let's talk about the advertising environment. And I'll tell you the moral of the story right now, and the theme and the idea that I want to convey, and that is understand what your bank is doing. And what I mean by that is understand whether you are participating or have purchased or are partnering with any third parties that are utilizing new and exciting models. So model risk management is, of course, a science within itself, but two areas in particular on the lending side, marketing and underwriting. And new and exciting criteria are being developed and utilized. And frankly, we have fintech to thank for this as well. And it may surprise you to learn that fintech companies, the criteria they use to underwrite and make loans are actually more predictive than what we as banks use. FICO and credit score and LTV and DTI, you know, those old standbys. But the fintechs are using different criteria. And they may use some of the other ones as well, but they use things like where you went to college. Now, could that be problematic? Well, it could be problematic if I went to a minority college and I'm judged more harshly because of that. If I'm downgraded because of that, you can see the disparate impact on the basis of race. Did you know that fintechs also use who your friends are on social media? In other words, they will look at your social media profile and look at who your friends are. And if you've got a bunch of deadbeat friends on Facebook, guess what? Your likelihood of getting a loan is now decreased. To which you scream, that's unfair. You know, that has nothing to do with me. Well, you know, it's kind of the maybe deadbeats hang out together. I don't know what the criteria it means there, though, but statistically, they have shown that to be a fairly predictive criteria. And that should worry anybody that whenever you get a Facebook friend request, accept. I don't know who these people are, but hey, they want to follow me, more power to them. That may hurt you. Now, are there fair lending problems with that? Perhaps. This is where we are as an industry. My point is to understand what you're using, because a lot of these vendors are now approaching traditional banks saying, we've got a better mousetrap. And if I'm a marketing officer or I'm the chief credit officer, yeah, I'm going to listen to what might be a better mousetrap. And from a marketing perspective, what might help my uptake or my response rate, or from a credit officer perspective, what might help me make better loans and the better chance of having a borrower that would actually pay back? Yes, I'm going to listen to that. So here's the poster child on the marketing side, and this is litigation between HUD and Facebook. Let's just say that one day you wake up and you say, we want to market on Facebook. We want to market our loans, and you know, it's the wave of the future, and people don't read newspapers anymore, and you know, everything's social media. So yeah, we better get on the bandwagon and start advertising there. And you call up Facebook and you say, we'd like to advertise our lending products, our loans, mortgage loans or credit cards or whatever, on Facebook. And they're going to say, sure, absolutely. We've got a great advertising platform for you. And essentially what you can do is customize your message and customize the audience that will see your message. And what you can do is identify those types of individuals, because we here at Facebook have everything, as we know. Just watch a couple of the documentaries on Netflix if you really want to be scared straight on some of the stuff. But they know people better than they know themselves. And they certainly know people better than we as banks know them, because we're restricted from doing many of these things because, hey, we've got ECOA and FHA and UDAP. And thus far, social media companies have not been held to those standards. So when you're talking to Facebook, they're going to say, we will give you screening criteria. And you are able to use our extensive data mining in our databases, and you can select certain characteristics. And you will be able to exclude either men or women from even seeing the ad. You can exclude people that don't speak English. You can exclude people that live in a particular area. We're going to give you drop downs and search boxes to exclude or include certain attributes. Well, what attributes can you choose from? You can choose from foreigners, women in the workplace, Hispanic culture, Christians, and the list is on and on. Now, HUD saw what Facebook was doing. And HUD, of course, is the regulatory agency for the Fair Housing Act. They had a couple issues. Can you imagine what their issues were? In other words, would you ever exclude women in the workplace or Christians or Puerto Ricans from seeing any of your ads? Of course not. Those are very clear discriminatory bases in both FHA and ECOA. Now, HUD, as you would expect, took issues with some of those and in the end sued Facebook. But they also looked at Twitter and Google. Now, Twitter and Google decided, no, we're not going to go to litigation. And in fact, there's information out there on what Google participated in with HUD to improve their platform to better align with the requirements of FHA. Now, Facebook, in other words, took a little more adversarial approach and said, look, we're not advertising mortgage loans. We're merely the platform. So we're like the newspaper or the TV channel. And what the ultimate lender selects and what they want to do using our platform is their problem, not ours. HUD said, we differ. Let's just agree to disagree on that. So we've done ongoing litigation. It's not yet been settled. It's one of those things that's taking forever. And of course, in the pandemic, it's going to take a while. But it's very useful information to read about, simply because it's instructive to understand what some of the risks are. But this is where we are as an industry. And my point is, understand whether any of your credit models and your work with database marketing firms, and there's all sorts of companies out there, don't trust that they respect ECOA and FHA. No, they're just the advertiser. And if you tell them to do this, they're going to do it. So you got to be very careful. All right, I do have these links on here. So look at page 22. This is what I was referring to a little bit before. Earlier this year, the FTC issued a blog post with lessons that they had learned about managing consumer protection risks of AI and algorithms and that type of thing. And they talk about fair credit reporting. They talk about ECOA, UDAP on these issues. So this is a good read, because it does talk about what some of those risks are. It's broader than fair lending, but hey, that's a good thing here. But they have some guidance and some recommendations, and talking about the foundation, watching for discriminatory outcomes, also embracing transparency and independence. And this doesn't necessarily mean transparency to your customers, but transparency within those third parties that you're dealing with. In other words, if I'm a database marketing company, and I'm selling my product to your bank, and I tell you, no, I can't tell you the technology, it's a black box, it's proprietary. That's a great big red flag. And if I won't tell you what the outputs are and whether any of their criteria are prohibited bases or proxies for those, you got to be very careful. That's where the risk is right now. Banks using a lot of these new technologies and models without understanding the inputs and the ultimate impacts, disparate impact of using those. So in that guidance, you see don't exaggerating what it will do, data transparency. Again, you can read these for yourselves. I don't mean to read the slides to you, but it was really good. And they talk about doing more good than harm, and they use section 5, and that's UDAP, that's from the FTC Act. And then accountability as well, and understanding that ultimately your bank is responsible here. Remember vendor due diligence and third-party risk management, very important here as well. All right. And there was also maybe I don't have that one in there, a companion issuance from the regulatory agencies this summer around AI and big data and what they may think is risky there as well. But let's get back to what some of those priorities are from the government here. And anytime you see anything written by Patrice Fickman, you want to read it. She is the director of the Office of Fair Lending and Equal Opportunity. She's been in the at the Bureau forever, it seems, pretty much since it was spun up. But she is the most important voice when it comes to fair lending from the CFPB because she is the director of that office. So you will see forewords and quotes from her in every year's fair lending report to the Congress. And I want to bring up one that she wrote 5 years ago in December of 2016. And this is where she said, we are going to have 3 priorities going forward, not to the exclusion of anything else, mind you, but we're going to concentrate on redlining, servicing, and small business lending. And I'm here to tell you with 100% certainty, they have lived up to that even this year. And this is why we have so many redlining enforcement actions. And obviously, servicing is a big deal here in 2021. We're still, in the tail end of the pandemic or wherever we are in it, who knows. But obviously, foreclosures and the eviction moratoria and loan modifications and distressed borrowers, a big deal. And the pandemic only made it worse. And as you saw from Director Chopra from the CFPB, the pandemic only exacerbated existing racial inequality. That means fair lending. And then small business lending. We're going to talk about 1071 and what that's going to mean to you. And I'll be more than happy to share my opinion. Those of you that know me, I'm always happy to share my opinion. I'll let you know what I've heard. Sorry about that. I'm driving me nuts here. Got 4 dogs running around the house. So that means there's a lot of dog hair floating around. And before the session this morning, I've got one big white dog that I was showing Katie and Larry, and the dog hair's floating around, so sorry about that. But then small business lending, so that is coming fast and furious as well. But let's talk about what this means to you. What would I do if I were you? Well, redlining is a big deal. Now, remember, this is not a new concept, dates to the 1930s, and certainly wasn't invented as part of Dodd-Frank or even when ECOA came around in 1974. But of course, redlining is when you make geographic decisions. And the classic redlining is we're not going to lend in this part of our area. And normally that meant we're not going to lend in the inner city or the more metropolitan areas for whatever reason. Maybe the credit quality is on average lower or the default rate is on average lower. So you decide we're not going to lend in that area. Now, of course, who does that impact? Obviously, the residents in the inner city. But if those residents tend to be majority minority, then you've got a problem. That's what redlining is. And if you're doing this consciously, then it will rise to disparate treatment as well. So it's clearly illegal discrimination. And we see a number of enforcement actions around that. Read that Townstone Townhome, can't remember what it was. Anyway, click on that link to see an example of that. But there are plenty out there on the web. Now, redlining as a concept has evolved. And that's what I want to talk about here for a moment. Now, these 3 terms in the middle of page 24, intrabank, interbank opportunity, those are mine. This is not something coming from any agency here, but it's my terminology reflecting how this concept has evolved. Traditionally, redlining is what I call intrabank. In other words, you look at what you do within your own business. And traditionally, in the old days, that meant put a big map on the wall and putting pins where the loans and the applications and the denials come from. And then, sitting back and taking the 30,000-foot approach and saying, are there any areas here that we didn't really get a lot of applications or make many loans in? And well, if that happened to be the inner city, then you've got a redlining problem. Now, that form of redlining has not disappeared. And I'm here to tell you it's certainly something that you want to keep up what you're doing. Look at what you're doing and look for conspicuous gaps in your lending activities. And banks do this anyway, if not for fair lending, for CRA on the business side. So yeah, you want to keep that up. But where we are now from a regulatory perspective is number 2, intrabank redlining. Redlining is now a comparative exercise. Now, regulators may still criticize you for what you're doing among yourselves, but is now comparing you against your peers. And for years, you might have thought you had a great map and you didn't have any conspicuous gaps, and the regulators always gave you a passing grade, no big deal. Now, all of a sudden, they're coming down on you. Why? It's because you don't look as good as your peers. Now, of course, this begs the question, tell me who my peers are, please. Who am I going to be compared against? And the answer is, unfortunately, it's not crystal clear. I can't show you exam procedure or anything else that says this is who your peers are. But I can tell you some rough general rules. Regulators will look at a volume test to determine who your peers are. And you may have heard of, if your volume of, they usually use mortgage loans because this is where the public data is, of course, for HMDA, between 50 and 200%. So within any particular census tract or MSA or larger political subdivision, any lenders that make between 50 and 200% of the loans that your bank makes or accepts that many applications, those are your peers. Now, sometimes regulators will also only look at other banks rather than fintechs and Quicken Loans and all the, Bracket Mortgage or whatever they are now, all those other competitors. Now, my recommendation is, and I've done a lot of this work over the years, both with banks and my Reliant capability, as well as when I was with it, KeyBank, but you want to do analysis of your geographic appearances against those of your identified peers, because you want to predict what your regulators are going to have to say. And you want to have the same data that they are. But then you also, and this is my recommendation, want to do a fair lending analysis against all of your competitors, whether they're peers or not, because that will give you a much broader picture of the total picture of your lending activity in your areas. Now, I understand full well what I'm saying. That's a lot of work. You just told me to double the amount of redlining work I do. I apologize. I'm sorry about that, but that is what the game is right now. It's a comparative exercise, but that leads to number 3, the opportunity assessment. You want that total picture because in my experience, too many bankers believe that their regulator understands their lending area as well as they do. So they don't make up any sort of presentation. They don't make up any explanatory information as far as why your maps look the way they do or why you didn't look as good as your peer group. What were the opportunities that you had? And honestly, there are a number of reasons that you may have gaps in your maps. And maybe it's because a big part of the county was mobile homes. You don't offer mobile homes, so therefore you're not going to have a lot of loans and applications there. A prime reason your map may look different is because maybe you're undercut by price by some of your competitors in some of those markets. You try your best. Maybe you've got a CRA loan officer there, you've got specialized loan officers there, but you just can't match the price of your competitors. So of course you're not going to get as much business. Well, do your regulators understand that? Not if you don't tell them. Don't presume they understand the marketplace and the environment as well as you do. And that's going to be one of my strongest recommendations for you listening here today. Make sure you can explain why your maps look the way they do, because redlining is at the top of the regulatory list as far as what they're looking for. Now then, the concept of reverse redlining, and I was never really down with the term reverse redlining. I always had to kind of look beyond it here, but reverse redlining is not an outright refusal to lend in certain areas, but rather you're going to alter the pricing or the terms. You may make it more expensive. And I remember working with a bank that wanted to price loans higher in Detroit because of the high incidence of title fraud. And they needed to do more due diligence with regard to applications in Detroit. So they wanted to charge more to cover for that. That is reverse redlining because you are targeting protected class consumers, because if they were to do it only in Metro Detroit, obvious disparate impact against minority residents there with products with unfavorable pricing. So to have that blanket policy, that's what the problem was. If you're spending an extra $500 on a particular application to ascertain clear title, okay, but you can justify that on a per loan basis, but not as far as an entire area. So reverse redlining, closely related, something you want to look at. Now, I'm not one to just talk at you as far as here's what the problem is without telling you at least some things you can do about it. because I've had to live that dream many times myself. I listen to people speak and they talk about here's what the problems are, but they don't give me any help or suggestions as far as what I might do about it. So I'm trying here, and what you see on page 26 are some suggestions what you might want to take into account for risk mitigation. And I have things here around self-assessments and some of the factors to evaluate, because these are what examiners are looking to. And the fact that you can analyze against some of these factors and come up with your own conclusions, perhaps some mitigating factors, going to be very helpful with regard to redlining. So there's a lot you can do as far as how this goes. REMA, I trust now that all of you are familiar with the term reasonably expected market area, or REMA. And this really came about 5, 6, maybe even 7 years ago. Time flies when you're having fun. But this is where your regulator expects you to be marketing and making loans. Now, wait a minute, you said your regulator expects you to be? The big deal with REMA is the fact that your bank does not determine what your REMA is. It's not like the CRA assessment area, but your regulator determines what it believes your REMA is supposed to be. Now, of course, it's related to your CRA assessment area. If anything, your REMA is going to be larger. It will never be smaller. I'm here to tell you that, but it's not the same. And I caution you, don't presume that your REMA is going to be exactly the same as your CRA assessment area. It could be, I'm not saying it couldn't be, but you want to be very careful as far as what you believe it to be. Now, we as an industry were outraged when the regulator said we are going to start delineating what we believe your REMA to be. It's not their purview to do it. Well, get over your outrage. This is the environment we live in. But in my opinion, the best defense is a good offense. And what I mean by that is be prepared for when your regulator comes in and says, this is what we believe your REMA to be, and you're not serving some of those areas, therefore you're redlining. That's how it happens. This is a form of a redlining exam. Now, REMA is the term that the FDIC coined and they use, but various regulators use terms like trade area and service area and market area. They all use it, the CFPB included. Now, the FDIC was kind enough to do a bunch of road shows back in about 2015 when REMA first was a thing, and they posted these presentations on the internet. So that's what this link is all about. So if you know what the regulator is going to consider in formulating what it believes your REMA to be, it's very useful information to us to figure out what we believe our REMA to be. So get that presentation, download it. They have a number of factors into what they determine your REMA to be. So your offense is to figure out what you believe your REMA to be. That way, if the FDIC or OCC or whomever comes in and they have a different opinion, at least you can have an educated discussion rather than being instantly thrown back on the defensive. And I remember back when REMA was first making the rounds, and the FDIC was doing those road shows, and it was an examiner out of the Atlanta FDIC named Gary Clayton. Now, I've known Gary for a while, really nice guy, and I cornered him in a couple of the meetings. Cornered him is kind of an aggressive word, but I talked with him, and I put to him, I say, well, I know the FDIC is telling banks what they believe these to be, but would you recommend that banks determine what they believe their REMA to be, and you can have a discussion? He said, absolutely, yes. Yeah. So think about what your regulator may believe this to be and react accordingly. I think it's a great thing to do. You can have that educated conversation. Next up on page 29, I promised a discussion on the concept of digital redlining. And maybe I should have put this back in the discussion of digital technology, but the concept of digital redlining means you are treating people differently that are on the digital platforms within your bank. There are inequalities, inequities between already marginalized groups, which of course race ethnicity, that works into this as well, because of the use of digital technology, digital content, the internet, social media. That definition comes from the House Financial Services Task Force on Financial Technology. So that's the term that they use. And the whole issue of digital redlining is, do you treat people differently because they are utilizing your digital channels? And the answer is, well, of course we are. It's cheaper, it's more efficient. We want to pass those cost savings on to our customers. And in fact, we want to encourage our customers to utilize digital technology whenever they can. It's easier for them too. Well, there is a risk of digital redlining here. So how you market your products and services, the differences in price and conditions and terms on the products that you have. Now, I make reference here to an article that's out there on the web about this whole concept of digital redlining. Full disclosure, it was written by a couple of the people that worked for me at Reliant when I led the firm's fair lending practice, but doesn't make it any less good. In fact, I think it's quite a good article here, but give it a read. And it really expands on a lot of these concepts that we're talking about here. But you see the differences in marketing, what you're advertising and how you're advertising, and who is likely to respond and who actually does respond. And it may be as simple as doing an analysis of how many loans, how many HMDA covered applications you get using your digital channel. And if it turns out that it's a whole lot more likely that a non-minority is going to use the digital channel to apply, where the minority applicant would use the traditional paper-based office visit channels and they end up paying more, well, then you've got a disparity here. And redlining is really an unfair term to use because it's not geographically based, but it's the geography of the digital environment where you are treating people differently. So you see a number of examples that I have there on page 30, different ways to mitigate digital redlining risk, reviewing your plans and doing some analysis of data and looking at your advertising, also mobile. One thing I should have thrown in here, during this summer, I think it was the CFPB, yeah. They actually issued a request for information. Remember, that's their first shot across the bow, acknowledging that many people today live their entire lives on this, right? Everything is conducted on the phone, not even a laptop, certainly not a desktop. That's for old folks like ourselves that need the great big screen to read stuff. But how do you put a full loan estimate disclosure or an account agreement for Reg DD? How do you jam all those disclosures onto cell phone screens? And what are the limitations and the risks that presents? And of course, there are many. So the regulators are thinking about how they might modernize the disclosure environment and just the regulatory environment altogether with mobile devices. And that's going to be an open question. It'll be interesting to see where they go with regard to that. But you can see how that dovetails with digital redlining, and how some of these concepts also come into play there as well. So what offers you make to me over my, whether it's laptop or cell phone and your mobile device enabled website, those types of things, there's a lot of risk. And not the least of which is fair lending, but also things like ADA. And how do the ADA requirements on websites where you must make them read out loud to people? How does that apply to mobile environments? So there's a lot of issues playing into that. But be aware of that concept of digital redlining. And I've just got some questions you might want to ask before launching a digital campaign and looking at the differences that may exist. All right, so that's redlining, and believe me, I could fill up the rest of the time on that, but I know time is not our friend here. I've got a little bit more than 35 minutes. So let's jump into fair servicing. And obviously servicing is a huge deal right now, has been for the last 18 months because of the pandemic. So many people in trouble, so many people late, so many defaults, and now you're looking at foreclosure and the eviction moratorium and all that stuff as this expires. And I think the beginning of 2022 is going to be an extremely active time. The CFPB recently this summer provided some additional protections over foreclosure during the calendar year 2021. And if they don't extend those, and I think it's 50-50 that they do, then we'll see a lot of activity in 2022. So there are a lot of very technical requirements to follow when you are servicing borrowers in trouble, defaults, modifications, and so forth. But now foreclosure is going to become a very big deal. And it's going to take a while to process all of those foreclosures. The courts are going to be backed up for some time. So there's going to be a financial impact on your bank. But regulators now are looking equally at what somebody got as compared to how they got it. In other words, how they got it, that's more the operational requirements, but what they got. Who was foreclosed upon, who got some loss bid assistance, who got a payment holiday, who got to keep their home, and who got thrown out. That's what fair servicing is all about. So understand that clearly fair lending concepts apply to the servicing environment, and all of those RESPA rules to consider loss bid applications, how you deal with incomplete applications, a very clear fair lending impact on that. It's like a mini credit underwriting process within the servicing environment. So look at your outcomes and apply some fair lending diligence to that. And a lot of the software providers, a lot of the HUDs software and analysis software also now are offering servicing modules. At Treliant, we own a software company. And if any of you have heard of a surety or risk exec, it's a HUDs data submission software. They recently offered and rolled out a servicing module. And they're not alone, but there's a lot that goes into it here. So there are clearly ways you can analyze this here. So of course, you've got a lot of the operational requirements, RESPA, Reg Z, service member issues around SCRI and MLA and error resolution and loss mitigation, but also looking at the process. So I have a lot more to say, but of course, be aware of those top line issues. Now, what about the commercial environment? Well, does fair lending apply to commercial loans? Of course, it never did, and it absolutely does. And I've got a little note there that there are some in the regulatory agencies that very strongly believe that the consumer protection regulations, Reg Z and RESPA, should also apply to sole proprietors. So to individuals doing business as sole props. Now, they can't do this because it would take underlying changes to the statutes, truth in lending and so forth, by Congress. But we know that fair lending already applies to the commercial environment. So there is a bit of increased enforcement as articulated by Patrice Ficklin back in 2016. So then it kind of begs the question, well, how do we analyze small business? And do we only look at the owners? We're going to talk 1071 here in just a bit. But the answer is no, you've got to take a different approach when thinking about commercial lenders, small business or otherwise. Because from a fair lending perspective, it's not just about the characteristics of the owners or the operators of the business. Who are their customers? What do they do? What areas do they serve? And what benefits might they have for various underserved populations or majority and minority populations, that type of thing. So again, understand the totality of your small business lenders here and be able to demonstrate that, no, we are doing the best we can to benefit the community. Sounds kind of like a CRA argument, doesn't it? Well, yeah, that's what I'm talking about here. Now, up until we have 1071 finalized, really the only option to get hard data on race, ethnicity, and so forth was by proxying information. And there are certainly risks to that approach. We'll talk a little bit about that as well. Now, I debated putting a lot of information around 1071 in this presentation or just kind of going over it briefly. And I decided on giving you more information rather than less. Now, I may run through this fairly quickly, but we're talking fair lending. And in the end, 1071 is going to be a fair lending rule. It's going to sit in Reg B, and it's going to be a very HUDs-like process to collect and submit to the CFPB annually data on small business loan applications. So very much like HUDs. So yeah, we need to talk about it here, and you'll see a number of pages around the specifics of the proposal. Now, it is a proposal. It's not finalized. It's nowhere close to being finalized. Months are going to go by for the industry to provide comments and the CFPB to eventually formulate their final rule. But beginning September, the Bureau did release their proposal. This was a long time coming. This was Dodd-Frank mandated. Why did it take them 10 years? Well, there are a lot of difficulties in how the statute was drafted. And due to other political winds and happenings, the Bureau kind of sat on it until a coalition of community groups in California sued the CFPB a couple of years ago and said, look, you guys are mandated to write this regulation because the law says so, you need to do it. So the CFPB entered into an agreement with this coalition of groups. And over the last few years, they had issued a number of progress reports and other information, which is how we were following how 1071 was going to develop. But now that's been all superseded by this proposal. This is where the action is. Now, in my opinion, and it's worth no more than that, which is not a whole lot, there may be some changes in the final rule, and I expect there to be a few, but not the heart of what these requirements are. And I'll be more specific as we go through some of these things here, but I'll start with my recommendation, and that is, if you've not done so already, sit down with your commercial lenders, sit down with the leadership, particularly those that would make small business loans. And we're talking about loans to businesses with less than 5 million in revenue. That was the point that the CFPB settled upon. And start to get them familiar with what's coming. And within the next 2 years or so, you're going to have a very HUDs-like process to follow. And that's going to be a cultural change. It's going to be a monster cultural change for commercial lenders, because they're not going to see any value add for this process, unfortunately, but that's what the law is going to require. And you're going to have to ask some fairly intrusive questions of small business owners, which traditionally small business lenders haven't had to do. Not only that, there's going to be a fairly tall technology mountain to climb. You're going to have the right types of systems and reporting and submission mechanisms, very similar to HUDs again, but start to evaluate today. What do we have now and what do we need to make sure this is going to happen? Now, the CFPB has done a great job of providing a lot of resources around this proposal. So I've got the press release and the proposal itself. It's only 918 pages, so some light reading on a Friday night, just kidding. But they do have a summary of it, and they also have there. I've got the link to the resources page in general, with all this stuff that the Bureau has. But the Bureau is also nice enough to publish a table of contents. And they have the page on the proposal where various issues are discussed, because it's a 918-page PDF and it doesn't have the links within it where you can click and go right to it. So that's what the table of contents is for. So that was a nice thing for them to provide. All right, fair warning here. There's somebody driving up my driveway and you may hear my four-legged alarm systems going off just in a moment. I'm in a closed room, but just warning you, you may hear some entertainment in the background. All right, so I've got a lot of information here, but I'm going to speed through this fairly quickly because you can certainly read it on your own. There's a lot written on 1071. But let's talk about some of the important issues. Well, who's going to be covered? Are there going to be any small bank or small lender exceptions that we can kind of get out of jail free on this thing? And the chances are no. Now, I would expect that this will be one of the more hotly commented upon provisions of the rule. But they say any entity that originates 25 or more covered credit transactions, which means small business loans, within the last preceding 2 calendar years, they're going to be covered. So they make the coverage requirement very inclusive. So the bar to be covered is very low. Now they may make some changes around the edges, but we'll see. But pretty much everybody's going to be covered. All right. What's a covered application? They go into a lot of definition there. I think I can skip over that. You'll have to define that for yourself. But you see some things that they decided to include and exclude. But notably, they did include credit cards and lines of credit and anything that may be HUDs reportable. You're saying, well, geez, we already report some of these apps under HUDs. Are we going to have to report it under this law too? Yes, it appears that is what is going to happen, including ag purpose. Right now, agricultural or farming, it's excluded under HUDs. It's going to be included under this. But you see some of the things that would be excluded, like factoring and leases and so forth. So that'll be very important to understand what you have to report when this becomes final. Page 39, this is important because a small business is one that had 5 million or less in gross revenue in the preceding year. That's a small business. Now, I remember when I worked at KeyBank, we had 3 divisions of commercial lending. We had small business, which was $1 million and less, what we call the middle market, which went from 1 to 10 million, and then we had institutional, which was 10 million and above. Well, then this proposal, this rule would impact both small business and part of the middle market. So you're going to need to figure out what departments, what individuals, what products is this rule going to impact in our bank? Part of the planning process, the planning phase of what you're going to do. But the CFPB made a very careful and important distinction here. So the definition is around a small business concern. Now the statute refers to the Small Business Act, so SBA standards. But the SBA standards don't have a rule of around 5 million or less. So the CFPB has to petition the SBA for its approval to define it that way under the law. It's just the way that the statute was drafted. Don't foresee any problems with that, but you never know. But the distinction the CFPB made was this regulation will cover only those businesses with 5 million or less in revenues. The way the statute reads arguably would cover any large business that was women or minority owned. So you would have to ask questions of every commercial business that applied for a loan. That seemed to be impractical because, as you see at the bottom of the page, 99.9% of women-owned and minority-owned businesses are small businesses. Not very many women or minority-owned businesses with more than 5 million in gross annual revenue. So to require every bank to ask that question every time would be ridiculous, to use a compliance term. No, but you know what I mean. So now it only applies to small businesses. So that's important. This is a great resource here on page 40. It's the data points chart. I've got the link to this document here. This has a blow-by-blow description of all the data that will have to be collected and submitted under this rule. So in your technology planning meetings and in your discussions around, well, do we even have all this stuff? Where would we get it? How would we collect it? How would we submit it? What's the database of record? All those discussions should be going on now. But download the data points chart. This is very similar to what the CFPB already publishes for HMDA, and it's a great resource. And they will republish this when the final rule comes out, I'm assuming, and they will have regulatory links and all information, but it's a great resource. And I can tell you, all the software companies are busy at work putting their processes and their products together based on this information. So you want to be sure you know that you have all this information and where you can get it and then report it. So I just have some pages here on all that information and what you report for every application, and then only for those that you originate or approve, the information that's coming from the applicant, the type of credit they're requesting, and information about the business. So you see a lot of data points that you might not now be asking or otherwise have. You might probably have the NAICS code and the gross annual revenue, but do you have the number of principal owners? Do you have the number of non-owner workers? Do you have their census tract information? No. So you may have to beef up some of the application processes that you have. Now, this is very HMDA-like in that you will request demographic information as well, ethnicity, race, and sex for at least one principal owner. Now, you know the whole process under both Reg B for mortgage loans and HMDA. If I refuse to provide it to you, but you can see me. So whether I'm in your office sitting across the desk for you, or we're on a Zoom meeting, this type of thing, I refuse to provide it to you, then you have to guess. That logic, that provision will come into this rule as well. So if you can see the principal owner who chooses not to provide his or her demographic information to you, you're going to have to guess. But if you don't see me, you don't have to guess. But look at this interesting fact here. You will have to provide at least race and ethnicity information, but not sex information via visual observation or surname. This is where the CFPB, for one, is considering how they are going to account for gender identity and sexual orientation. So how is that going to occur? Answer, don't know. They're thinking very hard about it. They got a couple of years until it actually has to happen here. But I would suspect sometime next year, we're going to see the final regulation issued, and it'll be very instructive how they require us as lenders to get that information. And if it's different than what we use now, and it is almost guaranteed to be different. I mean, right now you ask for sex, male or female, and then some is male, female, other, prefer not to say types of things. Well, is that going to be expanded? Is it going to be binary and all those other terms that we have here? Is that going to show up as part of reporting? Don't know. But I would also consider that whatever this final rule looks like, you can pretty much count on HMDA later being amended to reflect that process. So this whole issue about gender identity and sexual orientation is going to eventually impact our reporting under this rule as well as HMDA. So stay tuned for that. There will be technology changes as well as some cultural issues there as well. And then you see on 44 more information on ownership status and the principal owners. I'll let you read that for yourselves. Remember, it's all in proposal stage. Now, buried on pages 803 and 804 of the proposal, they had a sample data collection form. What might that look like? So it's kind of a sample like we have in HMDA, kind of similar to 1003, as far as what they propose this to look like. So you might want to check that out as well. There needs to be a statement, a disclosure provided to applicants that, hey, we're required to ask you for this, but we're not going to use it in our credit underwriting. I pulled out the language on that sample data collection form to show you where that is. And then you're also going to have to report it similar to how you do under HMDA. Now, at least the CFPB had a heart, because right now we report all of our HMDA data as of March 1st. And of course, you got to do CRA at the same day. To add this on, to report it on March 1st would really, unfortunately overload all us poor fair lending people. So they proposed that you wouldn't have to report this stuff until June 1st. So that would give you a little more time to kind of spread out the burden here. But then you'll have another data notice similar to what you're providing under HMDA. But you'll also have to enable a very strong firewall. Now, of course, that's a computer term, but here they mean a protection mechanism in place to make sure the lenders don't use this demographic information in the process. You will have to demonstrate how you ensure that anybody with a credit decision authority does not have access to the information so that they can use it to influence their decision. Different filing, different system, whatever the case may be, we'll get more information on that here. But you see a suggestion, separate piece of paper. I put some quotes in there as well. And then you'll have to retain this information for 3 years. Now, what are we going to call it? Is it going to be the small business law? Is it going to be the SB law or SBLAR? Who knows what term they're going to come up for this thing? We call it the CRA law, even though that's really a misnomer, but it's just yet one more reporting of lending related data. And here's the timing as far as when this will be effective. I can't see us doing anything before 2023, mid-year at the earliest. Maybe they'll do us all a favor and say you'll start collecting in 24, but who knows at this point. But doesn't 2024 seem way far out in the future? I mean, geez, it's crazy. But you know what? We're almost done with 21. And I always kind of say, bank technology and bank compliance is kind of like astronomy, where, a million years in astronomy is a snap of the fingers. Well, 2 or 3 years in compliance and bank technology and trying to enact certain things, that's a snap of the fingers. So time is not our friend here, and the CFPB will not be tolerant of delays, because they have already said, you guys, meaning the industry, and you can tell them from the Midwest, can't you? You guys instead of you all. You've had 10 years. You knew this was coming. So make sure that when the date comes, you're ready to comply. All right, so that's 1071. Certainly keep your eyes open. My recommendation, start having discussions now. There's the emphasis on data integrity, like I mentioned before. One final note on 1071, when the final rule is out, and you're going to have to start doing something, once you start collecting that data, start analyzing it right then before you submit it to the Bureau. You want to understand what that data is going to say about your bank before you're surprised that somebody has done analysis on it for you. Don't ignore that. Every time HMDA is amended, banks work so hard on making sure technically they can comply that they completely neglect what that data is going to say about them, and then they're criticized and they're surprised. So don't forget about the fair lending impacts of this data while you're worrying about the operational part. Now, I've got a note at the bottom of page 50, CRA is a fair lending tool. This is not new, but within the past few years, it's certainly been used fairly frequently. And within CRA is already the basis of if regulators believe that the bank is acting illegally and discriminating, it can reduce the CRA rating. And this has happened on quite a few occasions. So understand that your rating is at risk, your PE, your performance evaluation. Now, the regulators have confirmed that they will only knock your rating down 1. They knocked Wells Fargo down 2 because of the UDAP problems they had a few years ago, and everybody freaked out. But then they came out and said, no, we're not going to do that anymore, but you are at risk of being downgraded by 1 level. So it could go from satisfactory to needs to improve. But CRA is not written ostensibly to be a fair lending tool. But now that the authors of CRA have retired, the Congress people who wrote it, they have admitted that, yeah, there's certainly a fair lending impact. Because think about if there's so much concentration on your LMI areas, low and moderate income. Well, unfortunately, there is a correlation oftentimes between LMI and majority minority. So if you are judged on your activities within your LMI areas, that means you're judged in your activities in your minority areas. Fair lending is certainly an important aspect to remember there. I want to say a word about fair lending training. And I love talking to compliance people about this. Show me in the reg where it mandates that we do fair lending. Can't find it. It's not in there anywhere. Well, why then do we do fair lending training? Well, because we're going to get smacked around by our examiners if we don't. Well, I mean, that's the kind of cynical answer. Because we want people to be aware of these concepts. It's a critically important part of our compliance program, so we train for it. But it's a very effective control within your CMS, compliance management system environment. Sorry about that. So it's an important part of your risk assessment. Now, I have some recent trends in training here, and I've seen a lot of institutions criticized for their fair lending training because they use the same CBT, computer-based training. They use the same module that they've used for the past 20 years, the same 10-question comprehensive test at the end, and you feel you're comfortable, good to go. Well, increasingly, regulators are coming in and saying, well, you know what, is that really effective? And they think no. Well, number one, it's the same test I took last year, and I log on to the LMS or HR's website, and I got to watch this PowerPoint presentation, so I'm hitting page down as quickly as I can on my laptop to get to the end. Just get me to the test. I know I can pass it. I know what prohibited bases are, and it takes me 15 minutes, and I'm back to doing things that I actually am responsible for. Well, that's hardly effective training here. So that's what regulators are increasingly evaluating banks on, and they want to see more job-specific or role-based training, or job-based and role-specific. Choose your poison here. So in other words, is it useful explaining the application process for those that are processors? Or is it useful explaining servicing requirements to tellers? No. Maybe only 5% of the fair lending training applies to what I actually do. And if you haven't updated your training module in 20 years, we clearly have seen some changes and advances in fair lending interpretation. So what I'm saying is don't panic and think, oh my God, now we got to ditch our training and get much more specific. But what I am saying is understand and be prepared if you are criticized or if comments are made on your fair lending training. It might not be as effective as it used to be. Now, there's a lot written about LEP, and if you're unfamiliar with that abbreviation, it stands for Low English Proficiency. This is a term that HUD coined a number of years ago, but it refers to those customers, those individuals that don't speak English as their primary language. So from a fair lending perspective, you think, well, geez, we have a lot of Spanish-speaking customers. Are we required to offer them loans in Spanish? Or can we advertise in Spanish? What do we have to do? Well, I'll start with the bottom line, which is no, you're not required to do anything in any other language other than English. You are not required. You're not even urged to or recommended to by the agencies here. Now, up until recently, there was little to no regulatory guidance on this topic. And we'll talk about what the CFPB issued this past January. But on this page 52, it's all about what essentially the regulatory position was at this point. And I would still venture to say this is still accurate. So do you have to advertise in other than English? No. If you choose to, does that then obligate you to provide disclosures and statements and customer service discussions in Spanish? No. The rule, and it's not even a rule, but the standard is if you initiate a transaction in Spanish, for example, then the expectation is that you can continue the entirety of the transaction in Spanish. So that would be if you give me a Spanish application or certainly Spanish disclosures. But advertising is not initiating a transaction, it is inviting a transaction. So you can advertise in Spanish, but provide all the loan documents and the mortgage and the promissory note, the statements and everything in English and not violate anything. That is appropriate. But you do have to be aware that if you do choose to provide some of the disclosures in Spanish, say, then you're pretty much expected to continue the entirety through Spanish. Now, this has been an issue that has created a lot of discussion within the industry for years. And the CFPB early this year issued some guidance around this issue, LEP. Now, this was in response to a July 2020 RFI to the public and stakeholders like us as banks that sought information on ways to provide clarity under Reg B around these issues. So we want to know. Now, this is kind of a good news, bad news thing that the LEP statement has. The bad news is they did not provide us any concrete recommendations or rules. So you think, well, geez, it's just kind of still loosey-goosey. But you know what? That same bad news fact is actually the good news, at least in my opinion. Because the fact that they did not mandate that we do anything as an industry means it's still pretty much up to us as far as what we want to do. It did not upset the apple cart to require us to disclose in Spanish or advertise with disclaimers or anything. But it does address a number of the challenges and the issues and the legal aspects and UDAP and fair lending around LEP. Because you can clearly see the relationship between those that don't speak English and discrimination on the basis of national origin and or ethnicity. So there's a lot of information in here. I kind of summarized some of the takeaways. And it's just recognition of the risks that you take when you perform various services in languages other than English. Translation difficulties, having translators available, dialect challenges, what services are then expected to be provided if you treat me in Spanish, whatever, so a lot of issues that are in place. So I would certainly invite you to give that a read. It's as good as we have right now. And the good news, I believe, is it didn't mandate that we do anything. Now, we're closing in on the top of the hour, so I'll get to some of these issues that are critically important. But here's something that's going to be really, really interesting in my mind, but it's coming. In July, so just a couple months ago, the CFPB announced prioritization of resources to focus on racial bias in appraisals. Really? How's this going to work? Because I have serious concerns. Now, I have serious concerns from an operational standpoint. I'm a banker at heart. That's where I grew up. I started my career as a teller and worked for a number of banks, and I've been helping banks for years. I've never been a regulator. I've never been an appraiser either. But I question how we're going to deal with this. And here's the deal. When I'm required to get an appraisal because the reg says I have to, or underwriters, whatever, that appraiser provides an unbiased opinion of market value. And if the problem is that certain neighborhoods or geographies are depressed because of systemic racism, then does that mean the property should be worth more than what somebody is right now willing to pay for it? And how would that be reflected in an appraisal? I feel bad for the appraisers as far as what they may have to do. And maybe I'm overstating what's to come, but you see there were some roundtable discussions here, and the Bureau is pleased to participate in the President's new interagency initiative to address the issue. So it's a big deal. The federal government agencies are talking about it, but what's going to come from it? I mean, they're going to confront the same challenges that we're talking about right here. But it's something to keep your eye on in the future because it clearly affects fair lending. Because if you are basing your lending decision based on an appraisal that is too low, the loan doesn't work, we had to turn it down, but it turns out the appraisal was biased because of racial bias. Does that then mean the lender is liable and responsible? That's a stretch. My opinion is right now, but might that come into play? Don't know. Don't know. Just something to think about and keep your eye on as this issue evolves. All right. Got a number of pages here around fair lending with regard to the pandemic. And unfortunately, regulatory memories are short. And if you remember when the PPP project or PPP program came out, the regulators made it very clear that you will not be judged harshly from a compliance perspective if you participate in the PPP, because we want to get money into the hands of small businesses as soon as we can. And pull out all the stops, do whatever you can to make sure you do exactly that, which we did, which the industry did like crazy, right? I mean, we were very effective in delivering PPP loans to small businesses. Well, now we have a new administration, and there have been rumblings and even public statements that one of the CFPB's goals is to examine fair lending violations within the PPP. So does that go against the message we got just last year in many cases? Yeah. But my point is, if you were a PPP lender, I would start looking at your data from a fair lending standpoint. You may have to proxy to get to some of this race and ethnicity information, and that opens up a whole can of worms within itself. But understand that that is something that the new administration has stated that they are going to be looking at. So I've just got some pages here around the servicing environment and modifications and things to look at, especially in light of what's happened over the last year. And look at outcomes the same as you do process. Process is all about disparate treatment. What documentation you request from me, and did you want a lot more information from, say, Katie than you wanted from me, and the only differentiating factor is gender? You kind of get the point. But then also look at outcomes, because you can count on Fannie and Freddie looking at these types of things as well. We saw their commitment to fair lending in the future. And then just to kind of make the point I made earlier, the introduction of new data sources and criteria and digital environments is changing the business of banking. And is changing it rapidly. And banks are having to compete with fintechs, which have better, cheaper, and more efficient models. And so we are changing rapidly. So as compliance people, we have to be very, very plugged into what changes your bank is making. So any credit models, any marketing models, just want to reemphasize that point. The CFPB is considering their opinions on special purpose credit programs. This is a subpart in Reg B that allows you to set up credit programs to benefit traditionally underserved populations. So like lending programs to benefit women-owned businesses or minority homeowners, that type of thing. If you follow the provisions in Reg B, then you can do these things. So this is something you want to become familiar with if you're not already. You may be aware of it. Yeah, I kind of know what it's all about, but at least read this advisory opinion, because there's some clarifications and how these things operate. Because clearly, if you set up a loan program that will provide price breaks or whatever for women-owned businesses, you're discriminating against men, which you can do, by the way. You can selectively discriminate on the basis of gender, as long as you follow the provisions under special purpose credit programs. So they are very specified rules. Make sure you understand what those are all about. And then lastly, I've just got some other information, and just in the vein of providing as many resources as you can, the FTC annually provides information around ECOA and their work. Remember, they supervise non-bank lenders. And they have some other initiatives here and their enforcement orders. And lastly, you might not be aware of this, but the FDIC in February of this year released 9 videos on fair lending. And if you click on that first link, you'll get all the other links, but I just linked to them separately here. And you see fair lending around underwriting and steering and redlining and marketing. The FDIC has a pretty good program in place for executive officers and directors, and they've got a lot of really cool stuff. But these are pretty good videos. I got to hand it to them. So if you're looking for some maybe good information to mix into your training or maybe delivered to your board, especially if you're an FDIC regulated bank. That's some good stuff available to you as well. All right, so that takes us to the end here. I've got right at the top of the hour looking at my clock, but you know, Katie, I'm always happy to stick around a little bit longer. Kyle, if there are any questions, but I know that's a ton of information, but hopefully that's been helpful to you. Kyle, it's all yours.
Yeah, definitely a lot to digest. Really appreciate it, Carl. I don't know how you speak for 2 hours in a virtual environment with no human interaction, but you do a killer job. So
Too much practice.
Exactly. No, I appreciate you and your partnership as always. And like I said before, we will send around your contact information with both slide decks that we had today too as well, to all those that participated in this presentation. So they'll have your information along with the slide deck. And any questions, obviously we'll have Carl's information in there, so feel free to reach out to him. So again, really appreciate it, Carl.
You bet. Hey, thanks much.
All right, take care.
Thanks, Carl.
Thank you.
You bet. Thanks, guys.